Right, morning traders. Welcome back to Morning Break 8. Aiman here. Right, so looking at the S&P 500 yesterday, so the index managed to rebound and hold it gains above the 6,300 level over this week, despite the recent consolidation. So if this 6,300 level to maintain, the index may propel higher towards the 6,500 in the couples of session ahead. So if you see here, bullish crossover happened, and this shows that the bullish trend remains strong ahead. Well, sentiment are looking positive for now. Investors continue to assess the economic policy in the US together with the Trump tariff impact. So looking at the event that will happen next week, I believe investors are eyeing for the uh, jobless claims as well as the CPI and also PPI next week. So just keep on eye on this event. So looking at the Hang Seng Index Futures HSIF, so it continue its upward momentum, showing that the strong support has emerged at 24,400 points zone, forming reversal pattern of resistance becomes support. So at this juncture, we expect the index futures to continue its bullish trajectory, heading towards the 26,000 point level. So in terms of sentiment, as of yesterday, looking positive in the Hong Kong market. So this is a follow through from the China higher than expected export data to other region and not US, which I personally think it is a great move for China to protect its economy from this Trump tariff and reliance on the US. So this has adds confidence among the investors that the reliance of China's growth in the first half will hold up. So at this juncture, we still have a long positive bias in our report with stop losses back at 23,000 level. Right, for the WTI futures, crude oil futures, so it underwent a further selling pressure deep below 64 US dollar level to close at 63 and 88 cent after losing 47 cent yesterday. So WTI now has crossed the support and the near-term average also at the near-term moving average, indicating that the near-term trend is likely to be bearish. However, if it manage to rebound, we are looking at the $67 level first before any bullish momentum could push this WTI price to towards the 70 US dollar level. So with its 6-session decline for WTI futures, we saw that the sentiment is a bit negative and the market seems a bit volatile. So sentiment still lingering around the tight supply and demand concern and the uncertainty on the Russia sanction. Right. So back home, looking at the FKLI, so it closed higher on Thursday's session and breached above the resistance of 1550. So with the breach above this level, we now have closed out our short trading recommendation and now looking for long opportunity. So now if the index continue to trend higher, we may see that the index to travel towards the 1580 points, which also align with the historical level. So bear in mind that this is in this bullish trend, support tend to be strong. So any incoming pullback may resort to higher rebound, right? So, so far, looking at the FKLI sentiment for the Malaysian market, still positive, buoyed by the sustained buying interest as well as the further um, investors' confidence towards the Malaysian economy after our PM's remark on the pre-budget statement yesterday, right? So, looking at this week's fund flow, foreign fund are still in the net selling position. However, our market have been supported by our local big boys, where you can see here local entities are in a net buying position. So as for the daily sector performance, utilities sector is the top gainers at 0.61%, followed by tech sector at 0.19%. So you can find some opportunities for today intraday trading within these two sectors, right? So okay, if we were to look at these two tech and utilities, right? So we have few names to recommend in our watch list, and that is still currently on a pending breakup position. So we have a tech, Tenaga, YTL, Penta, also NextG, and not to forget Vitrox, UWC, and some other names, right? Okay, moving on to our Malaysia trading stocks. So today we have Malakov Corporation. So the stock has experienced a bullish breakout above the 95 cent, supported by the strong trading volume. So we expect the momentum to strengthen, and the stock or the counter able to climb further to test the next resistance at one ringgit, followed by the one at 1 ringgit and 5 cent. So if it happened to break up below this 92 ringgit, 92 cent level and form a new low, this indicate that near-term pullback and further reach below this moving average. Okay, so next we have Jati Tinggi Group. So the stock yesterday also has breached the resistance of 57 cent on strong trading volume. So should the bullish momentum hold and continue to trend higher in the coming session, the counter potentially testing the next resistance at 62 cent, followed by 66 cent level. So if it drop below this 53 cent level, this will open the door for a further correction phase. Okay. Right. Looking at the FCPO, so market pulling back yesterday, declining 27 ringgit, to close lower at 4240 ringgit level. Well, if you notice from the charts, it is now rejecting this 4,300 resistance level for straight second session, which tells us that this level is quite strong. Okay, so however, the palm oil futures are now trading above this 50-day average, showing that the near-term bullish trend remains intact. So we keep our bullish bias unchanged, eyeing for the commodity to hold its upwards trajectory, potentially hit, well, if not breach the 4,300 level again. Right, so at this juncture, we believe sentiment still on the positive side. Again, investors are still pretty much waiting for the next week's FPOB data. Right. So I think that's all I have for today, and I pass to Isha. Happy trading, everyone, and see you on next week's Monday. Thank you.
All right. Thanks. So, good morning, everyone. So, just a brief update on Malaysia ITI, which was released on yesterday. So, the official data do show that actually the industrial production for the month of June is stronger than anticipated. So, with the June IPI increased by 3%, so versus May level of 0.3%, which is higher than our in-house projection, which project for marginal decline of 0.5%, and also Bloomberg consensus estimate of 0.5%. So overall, the data points to a solid final second quarter GDP print on 4.5%. So with potential upsides towards 4.6%. So in terms of in detail, the manufacturing, the IPI was actually supported by continued expansion in the manufacturing sector output, which actually expand by 3.6% in this month. So actually, this is supported by a uptick in the momentum of domestic-oriented industries. So despite that, the momentum of the export-oriented industries remain flattish. It's also in tandem with softer export performance recently. So and then on the other hand, we also see that there's improvement in the mining sector output, where for the month of June, it still declined marginally by 0.01%, 0.01%, but it's a much more smaller decline than May's contraction of 10.2%. So this is why the IPI actually is stronger than what the market actually expected. So for the second quarter of the year, the IPI actually increased by 2%, so versus 2.3% in the first quarter. So the stronger than expected IPI in June, so driven by robust growth in manufacturing output and also improvement in the mining sector output, points to a solid final second quarter GDP print of 4.5% in the upcoming release by mid of August. So and then, but we still think that the trade headwinds remain a drag on Malaysia's outlook. So with renewed global tariff, especially the proposed 100% US semiconductor tariff, might pose some risk to the export-driven sectors. So looking ahead, the potential slower growth in major economies and also persistent trade tensions, especially following the end of the pause period, might pose significant impact on Malaysia's trade and manufacturing sector outlook, reinforce our cautious stance as well. So we do see that there's some supports for Malaysia IPI outlook in both near and longer term, despite that there's a two prevalent downside risks heading into 2025. So firstly, greater clarity on the reciprocal tariff, such as US imposing a reduced 19% tariff on Malaysia, down from the previous rate of 25%, will help to improve market sentiment and gradually lift the industry confidence in externally led growth. So over the longer term, we do think that the 13 Malaysia plan, with a total funding requirement of 611 billion ringgit for the period of 2026 to 2030. So in addition to projected GDP growth of 4.5 to 5.5% into the next 5 years, suggesting that Malaysia manufacturing space to be continued to be a key pillar of growth into the medium term. So however, we recognize that there's two key downside risks for Malaysia's industrial production backdrop and into 2025. So firstly, there are some downside biases where firstly, recent White House announcement of an imposition of 100% tariff on foreign-made semiconductors, and secondly, potentially some headwinds from the SSD expansion plan. So specifically, we are more concerned on sectors with strong export orientation, such as E&E, crude materials, and machineries. So these industries are expected to bear the brunt of both direct US tariff on Malaysia and broader spillover effects from ongoing trade tensions. So going forward, we will closely monitor sector-specific tariff, which could have substantial implications for Malaysia export-driven industries. We are particularly watchful of developments surrounding the US semiconductor tariff. So Malaysia chips export to the US were valued at $3.9 billion in 2024, which is approximately equivalent to 0.9% of our Malaysia's GDP, might face uncertainty over the impact of the proposed 100% tariff, especially given the existing exemptions. So notwithstanding the White House announcement of an imposition of 100% tariff on foreign-made semiconductors, we are comforted that firstly, 65% of Malaysia's semiconductor exports to the US actually come from American companies operating in Malaysia. And then secondly, more exemption likely to be seen for US chip-related companies in the near term. So that's all from me. I will just pass the line to the next presenter. Thank you.
Hi, morning everyone. Let me continue with a results preview note on Mr. DIY, which we have a buy call and target price of 1 ringgit 87 cent. Essentially, Mr. DIY will release its second quarter results on 13 August, which is next week. And we expect the results to come in within our and consensus expectation to be at around 150 to 160 million. This will imply a flat year-on-year growth from the 155 million reported last year. But if compared to the first quarter this year, which is obviously a high base being boosted by an earlier timing of Hari Raya, it will indicate a Q-on-Q decline. And hence, similarly for same-store sales growth, we expect the trend to be softer as well. But on a more positive note, the strong gross profit margin should continue to hold up given the favorable forex and increasing scale of operations. And with this, first half 25 will indicate an earnings growth of a high single digit to close to 10%. If our expectation materializes. In terms of dividend, we expect the payout to remain generous. We are assuming a payout ratio of 75%. This is in view of the strong cash flow generation of the company with limited additional capex commitment after the completion of automated warehouse. And in view of the elevated cost of living, we believe our consumers will continue to downtrade or try to bargain hard in order to stretch their money, and such environment bodes well for Mr. DIY to capitalize, given its entrenched network of stores with more than 1,400 stores, value for money product offerings, and established brand equity. On top of that, the recent enrollment into the SARA initiative could serve as another avenue for Mr. DIY to capture the spending of lower income group if this program or if this initiative were to be significantly scaled up on Mr. DIY's end. We have furnished more details in page 4 of our report with regards of this SARA enrollment. In terms of valuation, the stock is now trading at 20 to 30% discount to other comparable retailers, including 99 Speedmart and Eco Shop. And we believe such discount is unwarranted, given that Mr. DIY offers similar degree of earnings visibility as a major proxy to capture the resilient domestic consumer spending, and the sustainable gross margin expansion will be able to more than offset the impact of rising OPEX stemming from various reform measures. So all in, we are maintaining our buy call on Mr. DIY with unchanged target price of 1 ringgit 87 cent. Let me stop here and pass on to the next speaker. Thank you.
Yeah, thank you, Siang. So, good morning, everyone. We have SD Guthrie first half results. First half results came in at 62 and 70% of our estimates and also straight estimates. So, SD Guthrie recorded first half core earnings of 1 billion ringgit, and this is 60% higher year on year. So, the better than expected results was mainly driven by lower than expected interest costs, but also higher than expected CPO ASPs in both Malaysia and also PNG. So in terms of ASP, as the Guthrie recorded ASP of plus 4% higher than MPOB premium for Malaysia, and also plus 10% higher and also plus 10% higher for its PNG region. So in terms of output, first half output was at plus 2.7% year-on-year, and this is slightly below than our initial estimates of plus 4.6%. So moving forward, although SD Guthrie has guided for better production in the second half for Malaysia and also Papua New Guinea, it has been wary of its Indonesia output. So SD Guthrie has trimmed its FFP output to plus 3 to plus 5% year-on-year for FY26 from its initial target of mid to high single digits. So output-wise, unit cost-wise, first half unit cost was flattish year-on-year. And moving forward for the second half, they expect fertilizer costs to come in slightly lower for Malaysia, but it has tended for full year for its Indonesia and also PNG. So overall, SD Guthrie is looking for FY25 costs to come in slightly lower at minus 3% year-on-year. So in terms of its land sale gain, SD Guthrie is looking to recognize 500 to 700 million of its land sale with its JV with EcoWorld, and this is expected to be recognized by year end, so maybe in 3Q or 4Q. So overall, we increased our earnings estimate for the stock by 21% for FY25, and we haven't included the 500 million to 700 million gain from this land disposal with JV. So we maintain buy with a new TP of 6 ringgit and 10 cent. And the stock is currently trading at 19.6 times, and this is within its peer range of 17 to 22 times. So I stop here and pass on to the next speaker. Thank you.
Okay, thanks, Iftaar. Yeah, so moving on to Masing. Yesterday, Masing announced that it has already entered into a conditional SPA with vendor Mui Group for the acquisition of 1.485 acre freehold land where the Chorus Hotel KLCC is located. So this land is transacted at 260 million ringgit, and the acquisition will be funded via a combination of internal funds and also borrowings. The purchase consideration translates into a land cost of 4,019 ringgit per square foot, slightly high, but you know, the land also comes with 15 times plot ratio. So, you know, it's now quite reasonable. The site is strategically located at Jalan Ampang, within walking distance to, let's say, you know, Twin Towers, Surya KLCC, Intermart Mall, the Link KL Pavilion as well. Is also close to the Ampang Park Interchange MRT and LRT station. So the land will be developed into a premium service apartment project with an indicative ASP of 2,000 ringgit per square foot, with unit sizes ranging 500 to 1,200 per square feet. So this marks the Masing's first premium project in the KL city center, probably a decade after you know, Masing's Icon, after developing Icon at Jalan Tun Razak, M Suites at Embassy Road, and so M City along Jalan Ampang. That's about more than 10 years ago. So this development, this new project is mainly targeted at investors and also foreign buyers. In our view, we also understand that lately the Conley project by E&O as well as Pavilion Square also saw more foreign buyers, especially those from China. So we make no changes to our earnings forecast. This new project is slated for launch in first half next year. Near-term earnings will still be underpinned by the M series projects as well as the new launches as well. The M Grand Minori at near the RTS station was recently launched, and the first block saw encouraging take-up of about 90%. Some update on the DC business, the Southview DC Hub. So following the lapse of the collaborative agreement with Bridge on 30th May 2025, management guided that the team has been receiving a number of queries from US-based hyperscalers, and some have entered into a non-disclosure agreement, NDA, and they are currently undergoing technical study. Recall the second collaborative agreement with Bridge will lapse on the 28th October. So subsequent to the expiry, this should provide Marsiling with more flexibility to negotiate with potential prospects, probably those looking for bigger land parcels. So all in, we are maintaining our buy rating. Target price is unchanged at 183. Yeah, that's all from us today. Yeah, so happy trading today, and hope to see you all again next Monday and on our RHB Morning Kappa at 8. Thank you.